LLCs and living trusts, ownership transfer and probate avoidance. 1. The problem of improper funding. A common estate planning failure occurs when an individual forms a limited liability company, LLC, but never transfers its ownership interest into a living trust. Upon death, this omission forces the estate through probate, defeating one of the primary purposes of creating a living trust. A properly funded trust consolidates assets, minimizes court involvement, and allows seamless transfer to beneficiaries. Yet LLCs are often overlooked because individuals focus on titled assets like homes and vehicles, neglecting membership interests in business entities. Footnote: failure to transfer LLC interests into a living trust undermines probate avoidance objectives. 2. The assignment agreement as the transfer mechanism. The legal instrument required is an assignment agreement. Through this document, the member formally assigns all ownership or membership interests in the LLC to the living trust. The assignment can cover one or multiple entities. For example, an individual holding 5 LLCs may complete a single assignment listing all entities and transfer them simultaneously. This ensures that upon death, the successor trustee, not a probate court, assumes control of the LLCs. Footnote: an assignment agreement is the key document that vests LLC ownership in the trust. 3. Operating agreements and disclosure issues. After assignment, the operating agreement itself need not be amended to name the trust as the member. Leaving the individual's name in place reduces complications with lenders or underwriters, who often scrutinize documents involving trusts. The assignment agreement should be retained privately as proof of transfer but need not be disclosed during financing transactions. This approach balances legal compliance with practical access to credit. Footnote: avoiding amendments to the operating agreement prevents unnecessary lender scrutiny. 4. Tax treatment of living trust transfers. For tax purposes, the transfer of an LLC into a revocable living trust has no immediate effect. The trust is a grantor trust, disregarded for federal tax purposes, meaning income continues to flow directly to the individual's Form 1040. No separate trust return is required until the grantor's death, at which point the trust becomes irrevocable and subject to its own filing requirements. Thus, assignment of LLC interests into a living trust is administratively neutral during the grantor's lifetime. Footnote: transfers of LLC interests into a revocable trust have no tax effect during the grantor's life. 5. Practical consequences and access. Holding LLC interests in a living trust ensures that the successor trustee can act immediately upon the grantor's death. This includes managing brokerage accounts, closing investment positions, and interacting with third parties without court intervention. Proper assignment safeguards continuity of management and protects beneficiaries from delays and expenses of probate. In practice, this step transforms the trust into a functional tool rather than a theoretical construct. Footnote: assignments empower successor trustees to act without judicial involvement.